actual signings in place. But I give kudos to Fannie and Freddie for trying to be proactive on this, because we don't know, where this is going to get to and how much of a need for it is going to be there. So this is one of those preparatory sort of rules that are allowing us some flexibilities that we may need in the future, and we're ready for them if we do. But right now we're not, I'm not seeing a lot of them. Again, the big change is it used to have to be family. It used to, it was restricted more on type. We have flexibilities now on purchases and rate term refis. This is not allowed on cash out refinance transactions. But it is something that is available to us should we need to utilize it. All right. Okay, now on to the verbal verifications of employment. So, prior to all of this, the standard requirement was to get a verbal verification that a borrower was still employed close to closing. Usually it was within 10 days of closing, and that is both tightened and loosened at the same time. So the tightening is we now have to do those verifications within 3 days of closing, but the loosening is we have some flexibilities on how we verify that employment right at the end for those employers that getting a verbal is not possible. The primary way we've been getting it is written. So we'll get an email from the employer or some other kind of correspondence from the employer verifying they're still employed, right, at the time of closing. The rules on that is it has to be from the employer's email. So we can't get a Gmail, Brad at Gmail email saying someone's still employed. It'd have to be from their work email address so we can see their title, their signature, and make sure there's someone who is valid in verifying their employment, a supervisor, someone from HR, depending on the nature of the company, on who we can use for that. That's by far the most common. That's typically the way we're able to get these done, but there are additional flexibilities that, should we need them, we can utilize, which is the ability to utilize the most recent pay stub or bank statements to verify deposit of their most recent paycheck to show they're still employed. Now, depending on how often someone's paid, there could still be a pretty decent gap between that verification and when the loan closes, which is why, ideally we do option 1 first, which is the written version. And this is sort of a if we can't scenario, because there is risk involved the longer it is since they were last paid. But those are options afforded us by Fannie and Freddie should we need to utilize them. And, we do as needed. All right, so IRS transcripts, touched on this a little bit with the self-employed borrower. But this really, oh yeah.
Sorry, because I had this where a borrower, I met with them like a year ago, and now they really want to get going, of course, during the COVID outbreak. But he works at a restaurant, which is closed, obviously, and so he'll be getting unemployment. We can't use that income then. We would have to wait for them to go back to work. How does that work?
Correct. So there's really a couple of different ways things are happening to borrowers who are impacted. There are some industries or employers who are laying off or temporarily laying off employees so that they can get unemployment. There are some industries that are putting employees on leave. Some of those employers who are putting employers on leave are still paying them, some are not. As of right now, the guidance has not changed on how we can handle borrowers in all those different situations. So the current guidelines, basically, if someone is on a leave of absence, and that can be as a result of this, but if they're on leave but still employed, Fannie and Freddie have guidelines that allow us to use their income. And depending on the length of the leave, the nature of their income, typically there's some reserve requirements in order to fill the gap based on when the first payment's due versus when they're going to be back from leave. What we don't have any allowances for is someone who's put on layoff, even if it's temporary layoff. We can't treat a temporary layoff like we can someone on temporary leave. So as of right now, if someone is laid off, even if it's temporary, I've seen ones where they even still get health benefits, but they're laid off and getting unemployment. And I had one that I mean, it felt like it was exactly like temporary leave other than the verbiage. And I reached out to Fannie directly to talk through that one because everything else spelled temporary leave, except they were calling it a layoff, and the borrowers were able to get unemployment as a result. And as of right now, we do not have an option for those borrowers. They are laid off. We can't use that income. If we can qualify off other income sources, meaning a co-borrower or someone else, we could proceed and they could stay on the loan. But in order to use their income, they have to be employed at the time that we're closing the loan. All right. So IRS transcripts, touched on this a little bit. One of the flexibilities that has come down is the ability to proceed without actually having the transcripts. The borrowers still sign the form that's required so that when transcripts become available in the future, we can order them. But we don't have to have them to close. As I stated before, we are attempting the borrower obtained version just so we can see what's on there. But this transcript isn't just self-employed. If someone's got rental income that we're using tax returns for, or other reasons that we have tax returns, we have this flexibility to just get the executed form and not actually have the transcripts. Obviously, it's our responsibility as a lender to do our due diligence, and if there is something off or that could potentially be an issue on the tax returns, we have to do our best to address that. But the actual transcript has gotten more lenient right now, and we can proceed without, which has been great because the IRS is not providing them. So all right, so continuity of income, this really sort of just plays into everything that I've been talking about so far with Fannie and Freddie, that as a lender, our requirement is really to try and afford the flexibilities provided where we can so that borrowers who are willing and able to make their mortgage payment can get loans right now. But on the flip side, we have to perform due diligence to make sure that we are not putting borrowers in a situation or in a loan that they can't afford right now should this extend out, because nobody knows how long this pandemic stuff is going to last. And, that is why some of these things are more strict, why we're verifying employment closer to close, why we're doing some of the things we're doing with self-employed borrowers, to make sure that we don't have a situation where we're putting a borrower in a loan and all of a sudden, they can't afford it. Reserves are definitely a very helpful factor. Reserves, if any of you don't know, are additional monies that a borrower has available to them. Obviously, if you have more money available to you, it's easier for you to make your payment. So should something unforeseen happen with your income source. So that's why things like temporary leave of absence are allowable if you have the reserves to cover the gap, because you have a way to make your mortgage payment during that gap. So you'll also see reserves come into play when we start talking about some of the allowances on government loans, because again, a borrower that has reserves is more able to, we can be a little more flexible because they have that sort of backing to be able to afford their payment. I talked about the self-employed borrower due diligence, but again, like I said, last bullet point, I know I'm beating it to death, but we need to have sustainable home ownership. We don't want to put anyone in a situation where they're in a loan that they can't afford, even if they love that house. And so our job is to, really make sure we're following this guidance and, addressing any potential issues before they're an issue. Okay, this slide is still on Fannie and Freddie, and it's not COVID related, but it is, I think, something that's important, and it comes up a lot, and that's why I wanted to bring it up. And there was some pieces to it that Fannie and Freddie changed at the end of 2019, and I thought this was just a good opportunity while we're discussing Fannie and Freddie to touch on it before moving on to the government stuff. Talking about rental income, and really the first part of this is when we're talking about new rental income. So maybe the borrower's buying an investment property, or they recently acquired a property, or they're converting a property that they're vacating, they're buying a new primary and they're converting that property to a rental. Fannie and Freddie are slightly different on the requirements for utilizing that rental income. Both require a lease agreement. But Fannie stops there unless there's a problem where rents appear to not be applicable to the area. If rents appear to be significantly inflated, then we might have to do extra due diligence to make sure that those make sense for the area. Freddie, on the other hand, does require extra due diligence on new rentals in addition to the release agreement. They require either a market rent schedule, which is something that takes other rentals in the area and compares their rent to what the borrower's place is rented for, or some online verification. An example on here, Rentometer, but Zillow has it as well, where you can go up and look at similar properties and what they're renting for, and the rent needs to make sense based on that comparable information. They also want proof of receipt of the last 2 months' rent for a new rental. So it needs to have been rented for 2 months in order to use it on Freddie. Obviously, that can be an issue if something is becoming a brand new rental right when we're trying to close. So that's why most of these are done on Fannie. We also get a proof of security deposit and first month's rent on the Fannie. The other big change is really on how we utilize rental income. This is most common on a departing residence, but both Fannie and Freddie are aligned on this. But this is the big recent change that happened at the end of 2019, and that is the borrower's history is going to dictate the income that we can use. So if a borrower already has a history of renting, they already have a rental, and that history is at least a year, we do rental income the same way we've always done it. We utilize the full amount that we can, either based on the tax returns or 75% of the lease agreement if it's new, and we move on. However, if they do not have a history of managing rentals, but they do have a history of home ownership or having an actual primary resident housing expense, so they can't be rent-free, they can't live with family, and once in a while, pay something. They've got to have either home ownership or a verifiable present housing expense, but no history of home ownership or home rentalship. Then we can just use enough of the income to offset the payment on the current property. So I'm going to use the departing residence example. They're moving into a new primary. The prior primary residence was the only other home they ever owned. If they're going to get $2,000 a month in rents, but the total mortgage payment, including taxes and insurance, is only $1,500, we can use the $1,500 to offset the $1,500, but we can't use the full $2,000 and have extra income on top of offsetting mortgage. Now, if a borrower has no history of owning rentals, and no history of home ownership, and no verifiable history of a primary housing expense, then we cannot use any rental income. So if you have a renter or a rent-free living at home with mom and dad whose first property they're going to buy is a investment property, they've got to qualify without any rents in order for them to do that. Any questions on that? Does that make sense? All right. All right, Fannie and Freddie temporary appraisal flexibilities. This was huge, and this was huge in all the helpful ways, not the more difficult ways. As we know, especially in our state and the states around us, it's become more and more difficult to have appraisers go view properties. What these flexibilities allow are other options when a standard interior appraisal is not available. And that's key because we always start there. We try for a standard interior appraisal. If that's not available, either due to the state regulations during this pandemic or due to a borrower situation or appraiser situation, that's when we move on to the other options. The other options afforded to us kind of go in an order. You start with interior, you try for that. If that's not available, then you go to an exterior only appraisal is allowed. And that's where the appraiser comes out. They review the property from the outside. They don't go in. They don't have contact with anyone, and then they come back and they write up their appraisal.